everyone. I hope you're all doing well. This is Kavya Ravichandran. I'm here with a new concept today under financial accounting, which is called as elements of financial statements. So, what are we gonna? What and all can be considered as takeaways in this video? I would say by the end of this video, you'll be able to learn what is assets, what do you mean by liability, what is called as equity, or what is called as income and expenses. So, this will help you to concentrate on dual concept. So end of the day, if I ask you with the elements of financial statements, what are you going to learn? This will directly link with ideal concept. And if you don't know what is elements of financial statements, then there is no use of understanding statement of financial statements. By the way, so let's get started to understand how does the elements of financial statement works. So um, we have around to five different elements. Let's get into the session, people. So what are all those five elements are? Those five elements are assets, liabilities, and then equity or called as capital, expenses, and income. Okay. So these are all the five elements of financial statements. So if you have seen my dual concept video, then you're coming to elements of financial statements. By then you should understand why five elements of financial statements. So if you go to any business, the maximum types of transactions that you can expect in an organization is these five elements plus one more transaction, which is called as dividend or drawings, depending on the organization structure. Okay, let's straightly get into an understanding of what is asset, what is liability. Okay, let's not waste our time. So you will be having your own I wish you just have to comment if you need a notes that I'm writing. I believe now you can see a white screen. So if you need this, you just have to comment, guys. I'll be able to give this in the description. Okay. So because I believe my handwriting is little, not everybody can understand. Easily, I'm not uploading this. Okay. See, first understand what is assets. What do you mean by asset? So take a business. Okay, take a business. I would like to tell you guys there are two different words that I want you to get introduced today. One is economical, another one is monetary. Ma'am, what do you mean by economical? What do you mean by monetary? See, economical, when it comes to economical, that means I say a sasta wala hai. Like what is sasta wala? Cheap and best, right? So, or I would say, for example, I go buy a flight ticket from Bangalore to Mumbai and I pay economical class. I get paid around 2000 or 2500 for a flight and I fly to Mumbai. That is something that is economical in nature, right? But provided you pay more than that. What is more than that? You pay for business class or you pay for a premium economy. You just don't pay 2500. It is more than that. See, I would tell you if you have to run a business, I would think about economical, not luxury, right? I will go purchase the asset which is cheap and best in the market, or which where as a company or as a business I can afford it. I don't go ahead and purchase which is luxury enough. If I'm running a consultancy business, I will not go purchase something called iPhone to give it to my employees. Rather, I will go buy Vivo or Oppo, something which is under the budget of 10,000 per phone. I will go buy that. That is called economical. Ma'am, what is monetary? Monetary can be both economical and luxury. What is luxury? It is not required. Let's not worry about what is luxury. But I hope you know basic common sense is luxury is something beyond what we need, right? So wanting is different, needing is different. I might not need an iPhone to call a person, right? Yeah. But I want an iPhone that shows my level, status level, right? So we consider that as what we consider monetary can be both economical and luxury. Ma'am, that means economical can also be monetary. Yes, economical can also be monetary. So for an organization, what is so important? Economical, monetary. So an economical asset can be a monetary element. Yes, the end of the day, you pay 2500 to fly to Mumbai. That doesn't mean you have not, just because it is economical, that doesn't mean you have not paid for it. So very first word I want you guys to understand economical. For an organization, we always want what? We always want economical resource, not monetary resource. So if I'm going to purchase an asset, I'm going to purchase economical resource, not a monetary resource. Please understand. Okay, first thing. And so if you have an economical resource, You'll be having something called economical resource. And this economical resource, you're purchasing to the organization for what purpose? Why are you purchasing this? Right? So you're purchasing this to generate what? To generate economic benefits. Again, not everything is monetary benefits. Please understand, people. You are running a logistics business and you have a truck or a vehicle, logistics vehicle, where, because you are traveling from one place to another, is it directly dealt with the monetary benefits, people? No, we don't know. We exactly don't know how much this truck is getting you the monetary benefit, but we know technically it is going to either decrease your expenses or increase your income. That is when you'll go ahead and purchase any kind of assets, right? So I will go generate economic benefits from this economical resource. This is very, very important. Two statements everybody would understand by now is what I believe. Apart from that, you need to understand, let's say I pay, just writing for an example, I pay 2500 for a flight ticket. Yeah, and I say this is economy class. At the same time, I also tell another statement, 25,000 for a flight ticket, the same economy class. Would you believe it? Do you believe it, the second statement? Nobody in this world will believe. Yeah, see, sometimes happens. Yeah, ma'am, don't, ma'am, there are chances where I have to pay and go because of some XYZ. There's no flights available, all that I understand, guys. But even if you open today ke liye other flights, I don't think so 25,000 is something that you can look for, right? Yeah, and nobody would look for. Now you see, which is more reliable information? This is more reliable. Yeah, so the cost that I incur, cost can be measured. What is measuring? Measured reliably. What do you mean by measuring? Bringing into the accounts on what value is called measurement. Okay, cost can be measured reliably. That means, can I say for an organization, asset is nothing but an economical resource. Which economical resource? Present economic resource. To generate, their main motto is to generate economic benefits, and the cost can be measured reliably. Right? This is what an asset is in an organization. Now you need to understand, ma'am, why do we call it as asset? Why are we not calling any other word? See, if you have ever gone through a concept called capital expenditure and operating expenditure, you would know that. Otherwise, just listen to the next slide. Look at the next slide. Yeah, what is the next slide talking about? It says the International Financial Reporting Standards framework defines an asset is a resource controlled by the enterprise as a result of past events from which future economic benefits are expected flow towards the enterprise. That is what the definition is. So I will just little rewrite this definition for a better understanding. I would say is an asset is a present economic resource of an entity as a result of as a result of past events that has right to produce. See, I'm not writing anything extra. Whatever we discussed, I'm writing the same thing. Produce what benefits? Right to produce or generate the economic benefits, and cost can be measured reliably. If these things are, cost can be measured reliably. If these things are satisfied, I can go ahead and consider this as my asset in my books of accounts. So you need to understand, any organization will have asset. So the examples of assets can be, we can expect to have two different types of assets. One is current assets, another one is non-current asset. What is current asset? Anything that can be dissolved or converted into cash or used in the organization within 12 months of the period, we call it as current assets. Anything that expected to stay in the organization for more than 12 months or more than one operating cycle, or their purpose is to serve for more period, we call it as non-current asset. So what are all the examples of current assets, people? Cash, accounts receivables, inventory, all this comes under current assets. For example, cash. Today I have cash. It's a present economical resource. See, economical can also be monetary, please think. And it has, by using cash, I can generate more economic benefits and I can measure the amount reliably. Simple. Accounts receivable. So I'm going to get money from this accounts receivable. If I say today somebody has to pay me $1,000, I'm telling somebody has to give me $1,000. For an organization, it's an accounting receivable will be treated as an economical resource. It has worth of $1,000 and it can produce economic benefits, and the amount can be measured reliably. And similar goes with inventory too. Okay. So now comes non-current assets. See, we have IAS 16 property, plant and equipment in FR, where which only deals with tangible non-current asset called PPE, and we have other more standards to cover up the entire non-current asset. For now, for financial accounting level, if you know, under non-current asset, we have two different types. One is tangible, another one is intangible. What is tangible, ma'am? Something I can see, touch. Maybe this water bottle is tangible, but the screen that you're looking at me is intangible. That's how it works. Okay. So these are the two types of assets. I believe you guys have understood assets, and I'm moving forward towards liabilities. So if you know assets, liabilities is going to be very, very easy. Okay. Okay, let's move to the next point called liability. See, the way that I told for assets, the liabilities comes into the point. See, I told you liabilities, assets are treated as what? Assets are treated as present economical resource. But what do you mean by the word liability? We would have heard this from very long time. See, it has always an obligation to pay. Yeah, it always has an obligation. So now this point is you will be learning deeper when you get into financial reporting. Ma'am, how do we define obligation? You need to understand the obligation need not to be always monetary. Yeah, sometimes you have to pay money, but most of the times you have to perform an activity. See, I'm obliged to provide classes to you guys. Like, I'm not owing anything money to you, but however, I'm obliged to provide classes to you. I have an obligation. Yeah. So, my classes is something which is worth of money, but I'm still providing it to you, right? So, that is called performance obligation. So, when you pay somebody, we call it as monetary obligation. So, just like the way assets, I would also say liabilities is an obligation to pay. And when I talk about liabilities as an obligation to pay, once again, there's just something called probability here. What is probable? Probable cash outflows should happen. Yeah, I would like to say it is outflow. Cash flow would be outflow. And or you don't pay money, there should be a transfer of economic resource. For example, you paid me money, okay? Or you have given me 100 bucks. Let's talk something which is good enough. Have you guys ever, if you guys have ever traveled in metro and you come from metropolitan city, or if you have traveled in local anywhere, take metro pass or bus pass. Let's keep metro pass, metro card, metro card. So you'll go recharge that for 300 rupees. That 300 rupees, the moment you swipe in and you swipe out, yeah, metro is obliged to provide that service to you, right? Yeah, and they will cut only if the obligation is being satisfied. Similarly, let's say you go to Chroma or you go to a normal kirana shop, you give them 10 rupees and you want a cookie bag, so that you are obliged to pay 10 rupees to that person. The other person is obliged to perform an activity by providing the 10 rupees cookie to you. This 10 rupee cookie, for him, it's an economic resource by default. It's an inventory, isn't it? Isn't it an asset? So either they have to pay you money or they have to transfer an economic resource. We call it as what? We call it as liability. And technically speaking, this also, the cost can be measured reliably. So you need to know that, yeah, the worth of cookie has to be somewhere around 8 or 7 or 8 rupees or 10 rupees for that matter. So the cost has to be measured reliably both in assets as well as in liability. So if you go to the slide of what is liability, you see, what do you mean by liability? I just have to move a little. Yeah. What is liability? So liability is a present obligation to transfer an economic resource as a result of past event. But additionally, I would like to add something called there should be a probability. What is probability? If you have ever seen, if you guys are a fan of cricket, then you see there is something called win prediction, win probability that they would be displaying all the time. Yeah. So if you remember last World Cup, India had very, very less win prediction, and Australia, yeah, Australia won the cup. Yeah, Australia people had more. That is a probability, the likelihood of happening thing. Liability is nothing but a present obligation to transfer an economic resource as a result of past event. Now you see, Liabilities can be divided into two different parts, current and non-current. Just like your assets, anything that is going to take within 1 year in your organization, we call it as current liability. Anything more than 1 year from the reporting period, we call it as non-current liability. So current liabilities are most likely the results of your operations. Yeah. What is results of operations? You run a business and you have bought an inventory and you have not paid the supplier, that becomes trade payables, it becomes current liability. Okay. So, but when it comes to non-current liability, you deliberately go, like the way Vijay Mallya has borrowed money from SBI Bank, you go to the bank and you ask for money. Yeah, that is called non-current liability. Or you go ahead and issue the debentures or loan notes from the public to invest in your organization, where you will be considered that as non-current liability, right? Just guys can go through the example to have a better understanding. Now let's move to the third element called equity. You see, in an organization, elements of financial statements, it can be asset, it can be liability, and the main thing is equity. Yeah, this comes next. I really don't want a bigger sheet for this, but let's just have an understanding. Okay, so let's get into the third elements of financial statement. So from here onwards, it is going to be really, really easy, people. Yeah, because you got to know the major bit of assets and liabilities. So now we're going to get into something called equity. See, equity is going to be before that, let's go to statement of financial position. So if you've ever seen statement of financial position, this one side of the statement of financial position is filled with assets, and another side of statement of financial position would be filled with two different things. What is those two different things? One is liability, yeah, another one is equity. Now we follow dual concept. So when we follow dual concept, it brings into the understanding of accounting equation. What is accounting equation? End of the day, no matter what, my total of my assets will be is equals to my liability plus equity. What do you mean by this? Let's say the total assets in an organization is 1 million. End of the day, if I have to dissolve the organization today, this 1 million will be split into the ratio based on how much is owner's money, how much is outsider's money. Let's say I have started my business and I have invested $300,000 and I have taken loan from $700,000 from an outsider. If I shut down my business today, I have that 1 million either in the terms of cash or in the terms of inventory or in the terms of non-current asset. So I will sell all of this. I will liquidate into cash and I will pay to liabilities first, which is $700,000. Then I'll keep it myself $300,000. That's how things works, right? So that means, technically speaking, my assets equals to liability plus equity. If I have to tell it in layman terms, so the leftover in the organization after you pay to an outside person is called as what? Is called as equity. See, if I have 1 million in the business, I will first pay outsider because he or she will come and question me saying that why didn't you pay? Right? Yeah, it's their money and you have an obligation to pay. But equity owners are the ultimate risk holders. We have to go ahead and pay the leftovers to them. So I would go ahead and say leftover in a little fancy term called residual. A little fancy term for leftover is residual, or I would say residual interest. What is residual interest? The leftover in the organization. What? In the assets may, I would go ahead and out of this 1 million, $700,000 would be paid to liabilities. Remaining $300,000 will be given to equity, for example. So the residual interest in the asset. So can I rewrite this accounting equation as equity is equals to assets minus liabilities. So whatever in the assets I pay to the liability, the remaining goes to equity. Can I say after deducting the organization's liability in its assets, whatever the remaining is called as equity? Can we say like this, people? Yeah. So if you read the definition, what is equity definition? Equity is the residual interest in the entity's assets after deducting its liability. So you need to understand, we follow dual concept or double entry bookkeeping system based on the debit and credit, where you can see there is a linked video in the playlist of financial accounting where you'll know what do you mean by dual concept. Is you can pass the journal entries under 15 minutes, where I'll give the link to that particular video at the end frame. Watch until the end. Yeah. So I would just go rewrite what assets equals to liability plus equity. For example, if a business buys a car for $10,000 using a loan, so the car increases, like the asset will increase by 10,000, the liability will also increase it by 10,000. Correct? Yeah. So the equation stays balanced. I will increase asset simultaneously. I will also increase the liability. That comes the equity, the third elements of financial statements. Then we have two different elements, that is called income and expenses. But before I go there, I would like to tell you guys, if you see, we have dealt with three elements: assets, liabilities, and we have equity. All the three comes under one financial statement called statement of financial position. Okay, so let's move to the next element called income. Okay, let's move to the next element, people. The next element is income. First of all, understand what is income. See, end of the day, if you go sell something, that something can be you selling products that is meant to be in your operations, like for the trading purpose, or you give a space on a rent and you earn rental income, whatever it is. You guys need to understand, end of the day, if there is more income, that income either creates a cash or receivable. Correct, everyone? Yeah, either you'll get money or you are gonna get money in the future. Both is considered as what? Both are considered as assets. So whenever you make income, it increases the asset. Do you guys agree? If not, sometimes we also treat discount received as what? Discount received also considered as what? Or also considered as income, right? So what is discount ready received? See, I might have trade payables. What is trade payables? One of the current liability. In that trade payables, there is a reduction in payable. So that means it also decreases your liability, right? So an income can increase your assets or decrease your liability. End of the day, if you have more income, that will increase your profit. Understand, if you have more income, it increases your profit, and that profit will increase what? I'm sorry. The profit will increase what? The profit will increase the equity. Ma'am, only profit increase the equity? No, guys. There is another term which will also increase the equity. See, I as an owner has invested 1 lakh. Tomorrow I will invest 20,000 more because the business wants it. Is that 20,000 income? No. But business has made a profit out of 1 lakh. The business has made a profit of 20,000. Then the owner is subject to get the 20,000 back. That will get added to equity. That is called your income. But if the owner itself go ahead and invest more money in the organization, that is not called as income, right? So technically, income will increase your asset or decrease your liability. End of the day, if you do that, what happens? It will also increase your equity apart from the additional capital done by the shareholders. This is called income. If you read this, what is income? Increase in assets or decrease of liability that results in increase in equity apart from, that is other than, those relating to contribution. What is contribution? Additional capital from the holders of equity claim, from the owners, from the shareholders of the organization. That is called income. If you know income, expenses are the easiest one. Yeah. So decrease in assets, or see, income was increase in assets, expenses are decrease in assets. Income was decrease of liabilities, now increase in liabilities. There it increases your equity, here it decreases your equity apart from drawings or dividends. What is drawings or dividends? Those relating to distribution to holders of equity claims. So this might look little, ma'am, itna hai, but we got it done almost within 25 minutes or almost within half an hour. You guys need to understand that the whole part what we have gone through, it should be a kind of revision to you. Or if you are preparing for financial reporting, this can be a basic foundational video for you. You can't rely on this whole and go ahead and write the financial accounting paper, because you might need little extra knowledge on that. For that, you guys can just ping me or comment your details, or my email ID is available where you can drop a mail to me, and I will of course guide with more videos on that or more content on that, right? So based on the elements of financial statements, I would suggest you guys to not to miss watching on dual concept, which is very important for you to pass the journal entries. And before passing the journal entries, you should know the elements of financial statements. I think we have covered these two beautiful topics of financial accounting, which plays very foundation and fundamental, basic and foundation topic for you guys. So I would meet you in different video with different concept in the upcoming playlist. Yeah, thank you.